So I wanted to do this breakdown on GBP USD, go over my trade. I bought GBP USD today after the selling that took place this morning, after the slightly upbeat US unemployment that we had today, coming in below market expectations, showing some slight signs of resiliency and strength in the US labor market. Remember that last night on the Zoom call, if you guys watched the recording, we actually predicted that that would happen. But then tracking back a couple of data analysis days ago, we had projected that one of the buy scenarios on GBP USD that could unfold was a sweep of the lows underneath the 1.27 down into lower areas of interest and then a bullish reversal. And I mentioned to you guys in the breakdown that I'd be looking for buys above the 1.27 flat. And we got that in today's trade setup today during New York session. So I want to go over that. I want to go over why we saw sell pressure this morning on GBP USD, why we've seen sell pressure on GBP USD, and then why today we saw some bullish momentum back into the Great British Pound up against the dollar, even with the slightly upbeat US unemployment claim. So that way you all that are attempting to conquer these FX markets understand how fast on the drop of a dime sentiment can change and how to react to that, how to understand these things. So let me just share my screen with you guys real quick to show you that we had been gauging all of this. Let's share the screen real quick. So this is the fundamental report that I mentioned to you guys. I don't remember, was maybe like Monday or Tuesday I sent this out to you all. And I mentioned to you all, this is the scenario that I was personally looking for on GBP USD, which was a drop down into these two areas of interest, either the 1.265 or the 1.27. We got something close to the 1.265. I think price came down into like the 1.267 flat or like the 1.268. So close to the 1.265 to sweep these lows. All right, so where was I? So we had mentioned in this breakdown, you guys can see the screenshots. Remember that in FX, we always want to attempt to play checkers. Oh, sorry, excuse me, chess, not checkers. Okay, so we always want to forward project what the markets are going to do based off of manipulation tactics. Before the market makers move into higher prices, we know 9 times out of 10, they like to sweep lows. And then inversely, before they move lower, we know that they like to sweep highs. So play that and play those scenarios and try to formulate a bias about the markets based off of what they're going to do, not based off of what you think the markets are going to do, right? Because most likely, as a retail trader, you're expecting something to happen in the market based off of your own personal gain. Start to play these market maker gains. So I just wanted to show you guys that we projected all this in last night's Zoom call. I won't break that down. I sent it to you guys in the Discord. We talked about sell pressure on GBP USD if the unemployment claims came out robust, which today it did. So that presented a perfect environment for us today on GBP USD to discount into these lower levels, which we can see happened this morning. Just like we predicted on the pre-plan analysis. So you can see that sell-off down into the low 1.265 psychological level that we had projected in this market update. That was sent to you guys out, I believe, either on Monday or Tuesday this week. So well ahead of the curve because today's Friday. And we saw the bullish recovery. You can see the price targets that I had mentioned to you guys of roughly around the 1.28100. And price has significantly increased above the 1.27 and is making our way towards those key psychological levels, right? So how was I able to gauge all this? Why was GBP USD bearish over the past consecutive couple of trading sessions? Let's talk about that first. So that way we can understand the quick sell pressure that we saw this morning and then roll over into why the market just recently turned around and we've seen some bullish momentum in the Great British Pound against the dollar. So for those of you all who have not been tracking this, GBP USD has been primarily bearish because the Bank of England cut rates before the Federal Reserve. We know that if a central bank cuts rates, lower interest rate environment, investors then know that they're going to get a lower yield having assets or currencies denominated in that jurisdiction, right? So as investors started to pre-price that in before the rate cut, and then once the rate cut actually came out, GBP USD sold off in comparison to the Federal Reserve or the United States dollar that is maintaining higher interest rates for longer. So investors have had and have been getting a higher yield having their assets denominated in dollars and having said that domestic currency, right? Holding dollars instead of the Great British Pound. Then most recently, so now you guys understand why GBP USD has been predominantly bearish. If we just look at the higher time frame, we can see that reflected in price action, right? We've been making consecutive lower lows, lower highs, lower lows, lower highs, and that has been predominantly because of the divergence between the central banks. Bank of England has taken up a more dovish monetary policy stance, cutting interest rates due to dwindling inflation and weaker economic activity. Whereas vice versa, the Federal Reserve is still one of the only central banks who has not cut rates yet and is still seeing moderately healthy and resilient US economic strength, right? Albeit, yes, of course, last week's NFP report came out relatively downbeat. We're still seeing reports come out on the US front showing moderate strength in the US economy, right? So with that being said, those are the reasons why GBP USD has been predominantly bearish. Now, on the lower time frame, over the past 24 hours and during today's trading session, at the beginning of the New York session, if we turn on our session indicators, we can see that right at the beginning of New York session, we had a slight drop in price. This was primarily because of the upbeat unemployment claims that came out, with the unemployment claims coming out slightly below market forecast, showing signs of healthy and resilient US labor market figures. Still showing signs of some cooling as the labor market figures did come out well above the 221,000 threshold, which signals that we are in slight recessionary scare territory, excuse me, but still did come out lower than previous readings, right? So just keep that in mind. So we did see that tiny spike in momentum in the dollar this morning when that news came out, and we saw a slight decline in the price of GBP USD. This, to me, again, pre-planning this analysis was a perfect opportune moment because what I saw in the fundamentals and the headlines this morning was a shift in the divergence between the market makers starting to price in monetary policies from these central banks. So you can see here in the reports, and I want to really break this down for you guys so you understand how this creates bullish demand or bearish momentum on these assets, right? On these FX pairs. So you can see in this report is from today. Traders are currently pricing in a full percentage point in Federal Reserve rate cuts this year, compared with around only a 45 basis point rate cut for the Bank of England, which in theory, which in theory gives the pound an advantage, right? Then you can see here this report also states that the Fed has cut rates amid stock swoons before. So in previous market cycles, the Federal Reserve has come out well before their monetary policy announcement and done an emergency rate cut. So right now, the market is starting to price that in. You can see in this report, it says a sharp slowdown in the US jobs market, as I mentioned. The US jobs report today still came out in recessionary territory above the 221,000 thresholds, healthier than previous releases. Okay. But still, because it came out elevated above that recessionary scare threshold at 200, and I think it was 33,000 this morning, we're still seeing the market start to price in cooling of the US labor market, speculating that the Federal Reserve is going to start to cut rates at a rapid pace because of the cooling in the labor market that we've seen over the past consecutive couple of reports, coupled with lower inflation readings that we've also seen. Okay. So you can see it in this report. It says, the U.S. jobs market that touched off days of global stock market turmoil also fueled speculation that the Federal Reserve may not wait until its next scheduled meeting in September to cut interest rates. Indeed, interest rate futures contracts are expiring later this month. That tracks the Fed's policy expectations, shot to a 2-month high earlier in the week, and the bet that rate cuts would be lower by the end of August is starting to prevail in the markets. So think about this. If right now market makers are speculating that the Federal Reserve is going to cut rates more or larger than the Bank of England, what does that do? That creates more of a demand for the Great British Pound and less of a demand for the United States dollar intraday. Remember that these fundamentals, every single day, something new comes out in the headlines where these hedge funds, these asset managers that are sitting at their trading desks, running all these algorithms, are reading these fundamentals and reacting them and programming these algorithms to price that information and move these price fluctuations. So let me break this down for you guys. Since we're seeing more of a rate cut on the Fed side of things compared to the Bank of England, let's really understand this by using artificial intelligence to break this down. Okay. So first, we're going to talk about the interest rate differential and currency value. So interest rates, keep in mind, I've tried to break down for you guys why GBP USD had been bearish, higher time frame, why just during today, at the beginning of the New York session, we saw a slight drop in price, and now why we're seeing a turnaround. So that way you guys understand the full spectrum. And this goes into my trade analysis today because I stack all of these things. I stack fundamentals. Then I go into psychological levels. Then I go into technical analysis. Then I go into risk management. Then I utilize the delta zones for confirmation, right? So interest rates and currency strength. Higher interest rates in a country tend to attract foreign capital because investors seek higher returns on their investments. Conversely, lower interest rates tend to make a currency less attractive because the returns on assets denominated in that currency are lower. So let's take this into consideration via the Fed versus the Bank of England rate cuts and what I just mentioned. If the Fed cuts rates by a full percentage point, while the Bank of England only cuts by a 45 basis point, the interest rate differential between the US and the UK therefore narrows. And the USD, which was previously offering higher yields, again, the market makers are starting to price in that that might not be the possibility anymore. So again, what are they doing? Buying up the Great British Pound and selling their dollars for the Great British Pound, which we can see reflected in the price today of this basket of currencies, right? They were selling dollars to buy the Great British Pound after these headlines. These headlines stating that there might be a bigger rate differential, the Fed against the Bank of England, where they might get a higher return on their investment, having their assets, their said capital denominated in the Great British Pound, right? Let's continue this. So, expectations and speculative positioning. Market expectations. Traders and investors often move money based on expectations of future rate changes, which is why I try to teach you guys, just like when I do my forward projections, to play chess, not checkers. Think about what the market makers are going to do, where they're going to be targeting, how they move price. We know that if price is in a discounted area, there was a slight dead cat bounce. 9 times out of 10, they're building liquidity underneath of lows to drop price one last time to sweep out all the early buyers to grab liquidity, i.e. the momentum and the money that they need in the market to therefore then take price higher, which is exactly what we saw. When you've been in the markets for as long as I have, you start to understand that that's how they move. So you don't even react to price until you see those types of situations unfold, right? Then we have speculative positioning. This expectation can lead to speculative buying of the Great British Pound, which is currently what we're seeing. I'm not saying that the Great British Pound is going to flip bullish and recover from all of its losses during the past consecutive couple of trading weeks. But what I am saying is that right now, market makers and algorithms are speculating future rate cut differentials. And so they're starting to price that in, right? So you're seeing a slight buying of the Great British Pound and slight sell pressure against the United States dollar. I'm not saying the US dollar is bearish because it's not by all means, but when it's traded up against the Great British Pound, where investors in the future might get a higher rate for Great British Pounds, you can see that reflected in the price. So I will copy this for you guys so you have it in the fundamental notes. I won't bore you guys to death any further, but hopefully they get you all to understand why these market makers are pricing these two fundamentals in. And maybe anybody that was trading GBP USD is now not confused as to why we saw a slight drop in price this morning off the unemployment claims, and then a slight reversal in price. And now we're seeing bullish momentum as the day is about to come to an end for New York session. Okay. So using this information, using this understanding of the markets and doing a pre-planned technical analysis and not exposing my capital to the markets all week, that has allowed me this morning to take a strategical approach, understand what the market makers are going to do, and get into a position once key psychological levels were broken, which for me was the 1.27 flat. Once the 1.27 flat, which you can see was projected to you guys in this pre-planned market analysis that I sent you all, I mentioned to you guys that GBP USD is bullish above the 1.27, looking for price to head towards the 1.28. That's when I would look for entries into GBP USD. So let's break this down. You guys know now my macro perspective of why I took this trade, what supporting fundamentals gave me the confidence to take buy positions on GBP USD. I never buy price of anything unless I have something supporting my decision to expose my capital. So now that I've showed you guys how I laid that foundation this morning, now we can go into the lower time frame and we can break down technical analysis. Everybody in these markets, the vast amount of retail traders in this space make you think that technical analysis is the key to success in these markets. It is a piece of the pie, but it's a very small piece of the pie. If you don't have a fundamental understanding and you don't know why the assets that you're trading are moving the way that they are, you're going to get confused and you're going to find yourself guessing. And if you are the type of trader that's constantly guessing and not making an educated, rational, and logical decision in this market, you're going to find yourself losing more often than you win. I promise. You might win a couple of times, you might get lucky, but it will not last because the markets will always prevail, move against you, manipulate you, and confuse you. You'll get frustrated with yourself, and most likely it will result in you giving up. So I highly suggest you guys take it upon yourself. It's going to suck. It did for me. It took me over 3 years to understand fundamentals. Okay. But I also didn't have somebody like myself breaking this stuff down for you. I had to fucking I had to read textbooks and shit, like just a whole bunch of information, constantly feeding my brain information to get to wrap my head around this. Then artificial intelligence, like 2.5 years ago, really started to kick off, and I started to incorporate that into my trading regime, breaking these fundamentals down for myself. And now I understand it. It's very simplistic. And once you understand it 1 month, you're going to understand it the next month because these fundamentals, it's kind of crazy. They literally never change. It's the same reports every single month. CPI, PPI, core PCE, labor market data, Fed speakers, same shit every single month. Never changes. The only thing that changes is the tone, hawkish, dovish, risk on, risk off sentiment, the geopolitical landscape, that changes. And then again, obviously, of course, the price and percentages that all of these things move. But outside of that, the fundamentals remain the same. So once you understand what labor market can do negatively or positively to a certain asset that you're trading, you understand what it can do the next month and the month after and the month after that. All right. So anyways, now you guys understand the fundamental aspect. Why was I taking buy positions? That has now been laid. So that was my confluence number one today, as I understood that because of the rate differential that the algorithms were going to start pricing in, possibly in the near future, getting a higher interest rate on their Great British pounds, that was going to lead to slight intraday buy pressure on the Great British pound. On the lower time frame, hourly and below, you guys already knew based off of my pre-planned analysis that if we saw a sweep of these lows and a bullish recovery, I was going to be looking for buys. So I don't even need to break down the higher time frame, hourly, 4-hour time frame. That's what I was looking for. And we got that today. I wanted to see a bullish break above the 1.27 and some type of lower time frame bullish order flow above that. Meaning, again, what do we look for when we're buying? We like to see a area of interest that gets violated, a break of market structure that breaks a previous bearish leg, and a higher low that holds, leading to a continuation in bullish order flow. New highs and new higher lows being made, then we know that somewhere over to the right-hand side, we can get in on a trend continuation. Once we see this market maker pattern compared with fundamentals or combined with fundamentals, we then have a catalyst to back why we're going to expose our capital to the buy side, why we're going to be looking to buy, right? Targeting sell side liquidity. Okay. So with that in mind, you can see that institutional pattern here on the higher time frame. We see a sweep of lows. Here's price action, a pre-engineered low. The market comes in. These candlestick bodies break this low along with this wick. There's our liquidation event. And then these candlestick bodies hold this low. And we then create a higher low that leads to a market break in structure, where you can see my key psychological level at the 127 flat was violated. And this whole entire bullish leg engulfed this previous hourly lower high. So this is the same exact pattern, albeit, yes, of course, it's a little bit scattered out. It took over 1, 2, 3 different New York sessions to play out, but it is still this principle. It's this concept. I do not buy unless I see these things unfold: a pre-engineered low, a liquidation event, and a higher low that comes in after, coupled with fundamentals supporting bullish order flow or the possibility of further bullish order flow. All right. So now higher time frame, hourly, out of the way. We have fundamentals. We have institutional patterns showing signs of trapping people in the market underneath of lows prematurely, liquidating those positions, gathering up enough momentum to then shift market structure, having a higher low on the hourly come into print, breaking previous market structure. That was them game for me to jump down to the lower time frame and start to look for the next type of pattern, a trend continuation. So once we have this pattern, let's make this smaller. Once we have this pattern, we know that somewhere over to the right-hand side, what are we going to want to look for to get in for buys? We're going to want to look for some type of pullback. That means we're going to be looking at previous areas of interest where market makers bought from, utilizing our Fibonacci tool, taking price from the low to the high, where market structure was broken, where we can see here, this is a previous high that was violated. This might have been a previous high that was violated. And we know that if the market makers are not going to target lows anymore, they're going to look to target highs over to the left-hand side. And in order for them to do that, they're going to need to facilitate more orders into the market at a discounted price. That means we're looking for price to come back down into a 60 to 79% discount for us to get in to positions to take price higher. But first, we want to have supportive fundamentals, and we want to have higher time frame structure showing us that this is now the order flow of the market that we want to be trading in, right? You don't want to trade against that. You don't want to try to sell that. You want to try to buy that. So let me show you guys what I'm talking about. So now you guys have seen fundamentals. You guys have seen now hourly order flow. Now let's jump into the lower time frame. So this was my position today. It was a quick 30 pip jab at the market, right? Roughly about a 1 to, I think it was like a 3.1 risk to reward ratio. Okay. Here you can see my arrows are now going down to the fractal areas of interest. Let's just zoom out so you can see how that's reflected. This was that hourly area of interest that was set up as a trap, a previous New York session, because we're now on the 1 minute time frame. So remember, price action is going to be a lot more fractal. There's going to be a lot more candlesticks, and it's going to look like a lot more market volatility, but nothing's changed. Here you can see during this London session, remember, I've told you guys in previous video breakdowns in the CYPRX 2.0 content, if London session is going to buy, 9 times out of 10, they like to sell price first. Here you can see as a perfect example of that. London session was used as a manipulative session to drop price down to where previous areas of liquidity exist underneath of pre-engineered lows beneath this New York session, and then the market structure shifts. You can see a lower high here. You can see that London session before passing price action over into New York bought. Clear evidence of that is that this low compared to this high completely engulfs this entire bearish leg. So now, rolling into this New York session, you have an area of interest where London bought from. You can see that New York session, plain and simple, drop price down because they're not going to buy from highs. How many times have I shown you guys in the 2.0 content not to trade in this manipulative window from 3 a.m. to 5:30 a.m.? This is because 9 times out of 10, market makers are setting up a trap underneath of lows and above highs. Market makers drop price down during New York session, and they bought exactly where London session bought from. I saw this at the same exact time that I saw all these fundamentals this morning come out. So I was like, okay, plain and simple. New York session is now doing what London did, selling from a premium and buying at a discount. I want to trade in tandem with that momentum. So I wanted to see a break of market structure and I wanted to see price above the 1.27 flat. Keep in mind, zooming out, remember on the hourly time frame, this London session high was the hourly time frame high I wanted to see broken. So let's go back to the hourly so you can see what I mean. You can see how that translates. On the lower time frame, it looks like a bunch of crazy ass candlesticks. But remember, this is the hourly lower high from the trend continuation, and the dump down into the discount that we'd projected needed to happen. So this was the area I wanted to see broken before I was comfortable enough taking fractal scalps. That happened. We can see that right here. When the market broke above the 1.27 flat that's indicated by this white line, you can see we had a nice retest and price continued with the upside momentum, printing bullish order flow. Higher highs, higher lows, higher highs, higher lows, well above this previous market high. So that for me was a green light. Now, again, keep in mind what we wanted to see on the higher time frame. We saw a low, violation of that low, a break in market structure, which is where we're at now. Okay. Keep in mind, we're on the 1 minute time frame, but this was the hourly time frame that we wanted to see. So we've seen a low, violation of that low. Now what we want to see after the market on the higher time frame has broken previous bearish market structure, we want to see a pullback and we want to see bullish order flow, getting in at these discounted levels to look for higher prices. So sure enough, you can see that order flow here. Once the market created another higher low, I started to pay attention to the time efficiency paradigm. And we start to see that at 7:30, market makers printed a higher low here that violated a previous market structure high and created a new high in the market. This is now a higher low, higher high, higher low, higher high continuation. All I simply did to catch this move, after having confirmed that the market makers shifted structure, bought from an area of interest where London session was buying, broke key psychological levels, violating previous higher time frame market structure highs, was I took my fib from this low to this high, and I simply entered in at a discounted price. So you can see, taking my fib from the low to the high and extending that over. I personally don't use market execution. I use buy stops. I simply started to put buy stops above all of these bearish candlesticks. Market tapped into roughly around 66% discount from the previous area where they were buying from. And then my position was filled. I placed my stop loss nice and tight beneath these previous lows, i.e. these higher lows. Why? Logically speaking, in order for this trade idea to be invalid, market structure would need to shift and we would not need to start seeing lower lows and lower highs. So that was a safe place in my mind to put my stop loss, where that would invalidate my thesis that price is going to go higher if we started breaking and making new lows and new lower highs. Sure enough, we continued the trend. This was a beautiful trade where I didn't have to deal with any market drawdown. It was a straight shot to the upside. Beautiful 1-to-3 risk to reward ratio, easy in and out, not being greedy. I could have held this trade a little bit longer, but still, like I mentioned in yesterday's call, knowing the pair that you trade, GBP USD, give or take, gives you a solid 20 to 30 pips per day on a good risk to reward. So this was very beautiful, easy trade breakdown. I think I saw Angel catch the same exact trade, if I'm not mistaken. I don't know if he entered in the same fashion, but to some degree, I can guarantee you, he probably touched on some of these same exact confluences. A bullish turnaround, seeing that market makers were buying at a discount from where London bought from, breaking the higher time frame structure, the hourly was violated, right? And then scaling in and understanding that in order for these market makers to continue price higher, they need to print bullish order flow. When you understand that, that presents opportunity. Opportunity for you to enter in when these market makers are constantly facilitating more orders in the market at discount to drive price higher, right? So very simplistic breakdown from A to Z, fundamentals, backing my thesis of why price is going to go higher, understanding that shift in rate differentials being priced into the market. I'm not saying that that's permanently going to change the direction, but today, during New York session, we flipped bullish because of those supportive fundamental factors, followed by the technical analysis on the higher time frame, waiting for a break in market structure of where retail traders were manipulated at the beginning of New York session and where sellers still exist in the market above previous 1 hour time frame highs, waiting for those areas to be violated. Once those areas were violated and we got these structural confirms on the higher time frame, then jumping down to the lower time frame to look for entries. So think of this price action drawing right here. The yellow is the higher time frame, which we confirmed, and the white, after we've confirmed the fundamentals, and the higher time frame analysis is when you then want to scale down to the lower time frame to look for entries. If you're sitting on your charts, I promise you guys this, I'll give you another little tiny key tip. If you're sitting on your charts looking for trades in the morning or in the evening on the 1 minute chart, you're going to get manipulated and you're probably going to make irrational decisions. Zoom out if you're constantly losing. Zoom out and monitor price action on the 15-minute or the hourly. It's so much less chaotic and it gives you so much more comprehension and understanding of what the market makers are attempting to do and where they're targeting. Because a lot of people, right, on the lower time frame might have thought that this morning, because of the positive US news this morning, not necessarily positive, but healthier US news this morning, and this bearish drop in price that we had when I scale down to the 1 minute time frame, I'm going to show you, they most likely thought that GBP USD was going to continue bearish because of why? Bearish fundamentals overall for the Great British Pound that we've seen over the past consecutive couple of weeks with the rate cuts, bearish price action on the higher time frame, and then this morning, slightly upbeat data. So imagine how many retail traders today got caught off guard, not only because of those factors, but because look down at the 1 minute chart, you can see this morning, anybody on the 1 minute chart would have probably panic sold again because look at how volatile this downside move is, right? Imagine how many retail traders were sitting here thinking today, oh my gosh, GBP JPY or GBP USD, excuse me, is going to freaking sell off, getting trapped in positions above all these highs. When in reality, if you zoom out, you understand the breakdown that I just gave you guys and why market makers were buying, you can see that to the exact T of a degree, how I teach you guys in the 2.0 content to pay attention to previous areas of interest where banks were buying from in previous sessions, looking at where London session bought from, you can see that New York session literally bought from the same exact area and then shifted and started printing bullish order flow. Where right here, even on the lower time frame, the same pattern that I just told you all we need to confirm on the hourly and above before we start buying is the same pattern you can confirm on the lower time frame. Here is a pre-engineered low. Here is a violation of that low. And here is a higher low that comes in after. Once you see these things, then over here to the right-hand side, you can start to look for buys, right? But only after you get these confirms. Imagine how many people were trying to sell because of the fundamentals. Look at the time. This is when the news came out this morning at 5:30 on the dot, which slightly came out positive for the US. But again, retail traders don't understand all these metrics. They don't understand that these banks, these financial institutions start to price these things in ahead of the curve. Tap into that information because the information was there for you all this morning to capitalize on these moves. So easy breakdown, easy trade. I'll end my portion there. Does anybody on this call that caught this move this morning, if you did, want to break down their trade?
Can I say something really quick?
100%.
On the higher time frame, I saw that it was bearish, right?